Hello, class. Today we're going to be discussing a financial analysis of Omega Healthcare, and we're going to be discussing um, the assignment in accordance to our HIM 5370 assignment, and we have Mandy Redford, Sylvia Benitez, and myself, Charles Blanchard. For today's agenda, we're going to be talking about the company background of Omega Healthcare and transitioning further into the financial and operational overview, just kind of discussing more about their competitors in the market that they're dealing with, and more about the financial analysis, more specifically to the template that we completed in the Excel sheet, and discussing more about the revenue cycle management that we have created for Omega Healthcare, and wrapping things up with the summary and recommendations. So this is actually going to be taken over by Mandy.
Hi, I'm Mandy Redford, and I'll be explaining to you who Omega Healthcare is. They are a REIT, which stands for Real Estate Investment Trust, and that basically is a company that owns and in most cases operates income-producing real estate. They were incorporated in Maryland in 1992, and they provide lease or mortgage financing in the US and the UK. They work with SNFs and ALFs, which are skilled nursing facilities and assisted living facilities. And they also have some nursing homes, but 90% of what they deal with is skilled nursing facilities, and only 10% is the senior housing facilities. Omega Healthcare is traded on the New York Stock Exchange, and they are headquartered in Hunt Valley, Maryland. And recently they went under a huge merger in 2015 with Aviv, and they acquired 342 facilities. And basically it boosted what they had by nearly 50%, resulting in $9.3 billion as part of this acquisition. And then in May, which was the next month, they closed a purchase leaseback transaction for approximately $193 billion. That's included 23 care homes located in the UK. Also within the United States, they completed approximately $227 million in acquisitions. According to their website, the company's goal is to consistently provide increasing return to its investors while serving as a capital partner to its operators, so that they can concentrate on providing state-of-the-art facilities and the highest level of care for the residents, patients, during the transformational time in the industry. Talking about transformational time in the industry, more recently, the elderly is remaining more active into their 80s, 90s, and beyond. So the expectations are a little different than the old-time nursing homes. They're wanting more state-of-the-art things and activities for the patients. So these facilities are designed to enhance residents' quality of life and improve patient outcomes, reduce staff stress, improve patient safety, and reduce medical errors and infections. The benefit in turn is to improve the operator's financial profile, market value, and properties for the stakeholders.
And Sylvia's going to go ahead and take it from here.
Okay, so my name is Sylvia Benitez, and I'm going to just kind of tell you a little bit about what we found with regard to their financial and operational overview and analysis. Because they are an REIT, Omega does compete heavily in real estate and has a substantial amount of holdings in real estate, as well as those SNFs and the ALFs, as Mandy mentioned, the skilled nursing facilities and assisted living facilities. However, because they are so diverse, they do compete in multiple environments. They have some pretty big players in their market. Just to name one, Sabra Healthcare, they are an REIT, and there are multiple skilled nursing facilities. Another competitor is Brookdale. What was interesting to the team was to note that Omega, as Mandy mentioned, acquired a huge amount of real estate properties and assets last year. So with the next step that Charles is going to talk to us about, the actual analysis, there was some data that we were unable to capture simply because we couldn't compare apples to apples. Their revenue is also again generated by these skilled nursing facilities, and not only do they compete in the real estate market, they also compete in the environment of human resources. Healthcare is a very competitive environment, and sometimes, as Mandy mentioned, with regard to the growing trend of the population aging and living longer, there's a need for additional nurses and skilled nursing personnel. So not only, again, do they compete in real estate and the skilled nursing, but they compete for human resources. As a huge component, again, they have patients, and then they also have to consider patients' length of stay, because part of their financial analysis indicators show that they also have to be wary of CMS and Medicare reimbursement. A large number of their patients do come from the Medicare population, but they also do provide services for private care patients. So again, their reimbursements fluctuate, and they have to pay close attention to that fluctuation based on the yearly Medicare reimbursement that CMS puts out, the provider reimbursement schedule. So Omega does enjoy some significant assets, which overall indicate a healthy organization. However, as I mentioned, they have to be wary of that large debt. They have incurred a substantial amount of debt, and their debt to income ratios do show some variance that Charles is going to go into with you in just a moment. Their demands, because they are diversified, are going to vary across their market pool. Again, the real estate, the skilled nursing facilities, and the assisted living facilities. However, they do enjoy a favorable listing among their peers within their industries. So now Charles is going to talk to us a little bit more in depth about that analysis.
Thank you, Sylvia. So going into our analysis, we actually have more in-depth analysis provided in our formal paper, but we just wanted to take a snippet of the full-length analysis that we did and speak more to the profitability ratios, as you can see here on the screen. Part of the reason why we focused on this area over others in the analysis is, as Sylvia just mentioned, there were limitations on the calculations that we could complete due to the differences in the way that the balance sheets were presented in Omega versus our assigned competitor that we chose, which was Brookdale. So just kind of looking at the deductible ratio here, we did actually come up with calculations for the benchmark in the industry is about 4.68, which we use as the reference point to determine what is going to be favorable or unfavorable for our company's trends. So based off of the current year, it shows that they are at 8%. The current year that we referenced actually for our analysis is from 2015, as that was the most recent balance sheet that we would be able to utilize. So the current year is referencing 2015. So looking at that, you'll see that the 8% is higher than the industry benchmark, the 4.68. So we did go ahead and assign this particular category as favorable, just keeping in mind that the company is very real estate heavy, and more real estate heavy than a lot of their competitors, which they're depending on for a lot of their revenue. So looking at the total margin, that actually also showing, we did put that it is favorable in this area just because it is above the industry standard. However, if you look at the previous year, it shows a 44% previous year, again being 2014. Compared to the current year, it's showing 31% is actually trending in an unfavorable way. So something that you'll see later in our recommendations as to things that the company should be wary of in the years to come. And going further into the non-operating revenue ratio, you'll see, again, similar outcome with them starting the prior year in 2014 with stronger percentage rate of 93% compared to the 2015. They're coming in at 88.4, which is trending unfavorable. And we didn't have the capability to do the benchmarking in this particular section just because of the fact that so much of their revenue is real estate heavy, and that's not something that we can really gauge as there's so much volatility to the real estate market, and that's going to vary depending on the location, as Sylvia mentioned before, with them being spread across, such a large demographic. That's something that we couldn't really take into account with real estate. So the previous year, again, going to the return on assets, it's unfavorable, transitioning from 2014 from 4.2 to a 3% in the current year. And then moving into the last section of return on equity, it does show that it is still favorable because it is above the industry benchmark. But again, you'll notice the same thing with the other categories, that they're trending in a negative way. So it is unfavorable, and a lot of that is due to them taking on so much more debt that is outcome from the real estate. But they still have strong holdings and having that real estate value that they'll be able to still run the company successfully. So we'll discuss more on our recommendations on the company, and we're going to go back to Sylvia on revenue cycle management.
Thank you, Charles. Did formulate a revenue cycle management PowerPoint, which we will provide a link to in this presentation, and be more in depth for your viewing at a later time. Revenue is, of course, the money that a company will generate or that will receive as payment for whatever products, procedures, and services that they provide. It is the total amount of money earned prior to the organization deducting any expenses or taxes and any other kind of accounts payable. We designed our revenue cycle management based on a historical approach to RCM. In our PowerPoint, we also identified problems and we offered solutions. We identified the key players in the RCM, and a few of those key players are the patients themselves, which we discussed based on their SNF and assisted living facility holdings, the administrative staff, the health information professionals, the providers, and of course the payers who are responsible for generating their report. Now, in this particular revenue cycle management presentation, we didn't include the revenue stream from leases because, again, Omega is very heavy on real estate holdings, and they do have significant amount of income that they draw from leases. But we were focused here on actual RCM in health care and not in real estate leases. We were able to develop a capture process that includes the physician quality reporting system. We also included patient verification, providers, even the charting with regard to charge entry, and then the coding, the claim submission, and then posting. We also, in the at-length PowerPoint, included ICD-10 implications and the role of the HIM professional that proves to be a valuable link in the traditional approach to the revenue cycle management. Again, we focus particularly and heavily on the actual healthcare process. And this process would apply to their holdings in their skilled nursing facilities and their assisted living facilities. So again, we want to be very clear that we focus primarily on those processes with regard to healthcare and Omega Healthcare and their role in this particular environment. So at this time, I'm going to turn it back over to Charles. Thank you.
Thank you, Sylvia. So this brings us to our summaries and recommendations for Omega Healthcare. As you know, based off of what's been already presented from Sylvia and Mandy, Omega Healthcare is a publicly traded REIT with assets held nationally and internationally. Omega Healthcare has seen a significant increase in its portfolio. As a result, we found that the net revenue and therefore stock prices have seen a decline in the years that we actually analyzed from 2014 and 2015.
As well, the organization should sustain its profit margins, provided that the current real estate market trends hold. In other words, provided that the real estate market does not tank. It's really important to watch what the feds do, as well as watch the market rates in order to be profitable. And Omega should also consider more detailed review and additional debt consolidation. This is particularly addressing interest percentages while also reviewing the agreements in place under the unsecured revolving credit facility sanction of the balance sheet. Thank you for watching.
Thank you, everyone. For more detail, we'd be happy to share our actual paper and the more detail on our SWOT recommendation. Thank you again.
Thank you.